Japanese stocks have plunged to a historic low, even worse than when Japan was hit by the tsunami back in 2011. Major Japanese companies we all know, like Toyota, have seen their shares drop 34% from their peak, while Honda is down 30% from its peak. This is because foreign investors have been dumping both Japanese bonds and stocks over the past week. The total sell-off amounted to 1.56 trillion yen, which is equivalent to about $1 billion. $10 billion? Whoa, what's going on? Is it because Japan raised its interest rate to just 0.25%? That's barely anything. But today on Sai Money Monster, I'm going to explain just how this so-called tiny 0.25% is actually a small number with a massive impact. Thank you so much to everyone who's been following the Sai Money Monster channel. Our subscriber count is almost at 100,000 now, and it's only been less than 4 months. Wow, I'm really happy. I really want to hit 100,000, so if you haven't subscribed yet, please hit that subscribe button for me. Thank you so much, truly, for all your support. If anyone wants to support the Sai Money Monster channel, you can do so right here. Just use this QR code. You can support us, and the proceeds will go toward encouraging the team members so we can create even better quality content. Everyone is so happy and motivated to work, and it also inspires me to write even more fun and interesting content. And with that, we'll be able to share financial stories and help people understand macroeconomics in a much simpler way. When people know more about finance, it gives everyone a better chance at improving their quality of life. Thank you all so much, truly, for supporting the Sai Money Monster channel. But if you don't want to scan the QR code, that's totally fine. Just hitting like, sharing, subscribing, or leaving a comment to cheer us on makes us really happy already. Thank you. The Nikkei stock market in Japan has dropped sharply. If you look back from around July 11th, which was before the interest rate hike, right? The Nikkei had been climbing high, but by the time I recorded this video, it had fallen by as much as 20%. The market must have been really shocked by the interest rate hike. Japan's policy rate was raised to just 0.25%. Hey, 0.25% sounds so small, right? It's not even 1/4%. In this video, I'm here to break things down and highlight the key points for you, just how destructive that seemingly tiny number can be. Take a look at this chart. You'll see that this policy rate hike to 0.25% is shocking for one main reason. It's Japan's first policy interest rate increase in 2 decades, 20 years. The last time they raised rates was in 2007, when it went up to 0.5%. But after 2007, when Japan raised its policy rate to 0.5%, you can see from the graph that the rate dropped, and then it stayed in negative territory for 8 years before it gradually started to climb back up to where it is today at 0.25%. So when people say Japan raised its rate to 0.25%, that's actually a big deal for them. One of the reasons Japan had to keep its interest rates so low, actually in negative territory for 8 years, was because one of the reasons is that Japan has a huge amount of debt. Japan is a major economy with debt as high as 217.2% of its GDP. To put it simply, imagine if you earned 100, a debt of 217.2% means you make 100, but you have to pay off 217 in debt. No matter what, with this ratio, you end up poorer. But there's another perspective. If you can earn a lot, then having a lot of debt isn't really a problem. Japan is the 3rd largest economy and can generate a huge amount of income. So if they can keep making that much money, even a high debt ratio like this might not be an issue. But that's not the case anymore. And let me tell you, that debt to GDP ratio of 217.2%, that's an extremely high number, right? And with such a huge amount of debt, if interest rates are also high, it just adds to the debt burden. Raising interest rates increases the interest burden, and if Japan were to raise interest rates even a little, it would massively increase their debt load. That's why Japan absolutely can't just raise interest rates recklessly, because it would only add more debt to their own financial system. But Japan does seem to be cautious in one respect, because they say that even though their debt level is that high, most of Japan's debt is actually domestic. But it's this domestic borrowing system that's actually hurting Japan. Right now, Japan's domestic borrowing system is what's destroying the value of the yen. So what's happening? Basically, the BOJ, the Bank of Japan, is printing a ton of money. They're printing so much money and lending it to the Japanese government. If you look at this chart, you'll see that the BOJ, or the Bank of Japan started injecting money into the system, what's called printing money, or QE, quantitative easing, since 2013. All that money that's been printed and pumped into the system, up until today, if you look at the balance sheet, it used to be about 200 trillion yen. Now it's shot up to 760 trillion yen. That's a 4.5 times increase. Let me emphasize again, this massive increase is all from QE, or you could call it injecting money into the system, or just plain money printing. It's all the same thing. So why does Japan dare to print so much money? Personally, I think it's because Japan has a lot of confidence in its own economy. And honestly, that confidence is probably justified when it comes to the phrase made in Japan. Over the years, everyone knows and can see for themselves that Japanese products are high quality, have great technology, and are reasonably priced. When I say this, almost no one disagrees, right? Whether it's Japanese cars like Toyota or Honda, everyone knows. Great looks, reasonable prices, especially when you compare them to European cars, right? And when it comes to electronics, honestly, if it's Japanese made, everyone is confident that the quality is good. Japan is a country that really cares about its customers. They're always focused on improving their products, and they manage to keep prices competitive too. That's why Japan is so confident in its economy. And even if things don't really change, Japan still remains committed to developing the quality of its products. Search RMB. They deliver both quality and good prices. So domestic trade in Japan should continue to be just as popular. And if Japanese products remain in high demand, the yen will also be sought after in the market. So as long as Japanese trade stays popular and the yen is in demand, the yen will keep selling. Underline that. The yen will keep selling. And if any currency in the world continues to sell well, then inflation will. There won't really be any problems with borrowing money, and the currency itself won't really have any issues either. But today, Japan's economy can't stay the same as before, because Japan is now facing competitors who Japan just can't compete with China, and that's caused the popularity of Japanese products to decline. Japan has already lost its market share in the automobile sector to China, and the auto industry is one of Japan's biggest industries. It's not just about losing market share in terms of numbers. Japan has actually lost its stronghold, its competitive base in the auto industry, to China. For example, in Thailand, China has completely taken over the market. Japanese car manufacturers that have been based in Thailand for a long time are now shutting down one after another. Meanwhile, Chinese EV factories are lining up to set up shop in Thailand instead. So how big of a loss is this? Japanese car companies and factories have been in Thailand for 10, 20 years, contributing so much to the economy, creating jobs and bringing in money for the country. Something that seems so stable, now even that is being wiped out. Can just be pushed out like that. It was a huge loss. And what happened in Thailand was just one part of it, because Japan didn't just lose market share in Thailand, but all over the world. So this led to a combination of factors that caused economic and financial problems for Japan. Japanese trade lost a lot of popularity and demand, so the yen became less in demand and its value dropped. On top of that, Japan was so confident in its economy that it printed money to lend to itself domestically, which caused a huge bubble. And they've also kept negative interest rate policies going for a long time. So actually, inside Japan, there's a lot of inflation. With so much money pumped into the system, plus negative interest rates, normally in other countries, if there's inflation, they would raise interest rates. But Japan, they just keep printing. They keep borrowing money, but still maintain negative interest rates, which has caused the amount of money in Japan to overflow, like water flooding over goods and services. There's way more money than there are goods and services, so the prices of those goods and services keep going up. That's inflation. Plus, raising interest rates isn't easy because the debt to GDP ratio is as high as 217%. If they raise interest rates even a little, it would turn into an interest burden or a liability. This is something that keeps piling up and weighing them down. So it's become a real problem. Now that the Japanese government has raised the policy interest rate to 0.25%, it's basically increasing the interest rate on itself. And when they raise the interest rate on the debt they're holding, we can't just look at the government alone, because the rising debt isn't just the government's problem. Private companies, businesses, and ordinary people will also face a heavier debt burden because of the higher policy interest rate. When financial burdens increase at a time when Japan's economy isn't doing well, it just makes things worse. Japanese people end up with even less purchasing power. When it's harder to make money but debts keep piling up, people's quality of life goes down. It all comes back to the same loop. People just don't have money to spend. So who's going to have money left to buy the goods and services from companies listed on the Japanese stock market? That's why the stock market is so deep in the red, just like you've seen. In summary, this is what the increase to 0.25% really means. Such a small number, but with such a massive impact.